We have all of the major news that you need to know on this Sunday to get your trading week off right coming tomorrow morning, and boy, is this exciting. We're also going to look at the major catalyst happening this week that will move your portfolio. Let's get into it. The first bit of breaking news is Ross Gerber sending a direct message to the Federal Reserve telling them to force Taylor Swift to end her tour. And that will definitely have a bigger impact than 25 basis points. No, seriously, Ross Gerber says Lucid is going out of business. It's just a matter of time until the Saudis pull the plug versus losing billions more. These comments come just hours after Lucid cut pricing by almost 19%. They dropped their lowest end models by about $7,000 and their higher end models by about $15,000, and also pretty dramatically cut the leasing payments for these vehicles. This is being reported to us from Sawyer Merritt here on Twitter. Thank you for all that you do. I think the bottom line is simple, and I think Lucid highlights this. You just can't compete with Tesla. Tesla is so far ahead of everyone else as far as scale and profitability. To be able to get to the same point Tesla's at, it's really going to take a miracle. I don't think GM, Ford, or Lucid, or anyone else is going to be able to, for that matter. We now have some very, very positive good news for Tesla. This article says Tesla's Chinese suppliers rushed to set up EV component plants in Mexico to support new Gigafactory 6. 3 executives with Chinese car part firms told the Post that they were invited by Tesla to build factories in Mexico. Quote, "It is a win-win scenario," said Peter Shen, an engineer with car parts maker ZFTRW in Shanghai. To be more specific, 7 part suppliers to Tesla have already confirmed plans to build factories in Mexico, ranging from investment sizes of $100 million all the way up to $500 million. Tesla has said its factory in Mexico will have a capacity of about 1 million vehicles a year and is expected to be operational in the second half of 2024. So this could have a material effect on Tesla stock because it's coming next year. This is something the bears will not tell you, but it's something you should know as a Tesla investor. On to the next bit of breaking news. If you live in Colorado, let me know down below in the comment section, but you could be soon getting your hands on $26,500 worth of discounts to buy an electric vehicle. Colorado currently offers a $5,000 tax credit and is already the most generous state level incentive available to all residents, with additional programs set to go live in the next few months. Not just for the folks in Colorado, but now all Tesla Model 3s that are used and are bought are eligible for a $4,000 vehicle tax credit. Also in the news over this weekend, Pepsi is showing off their 21 Tesla semis. And a Tesla semi-truck driver, kind of a different thing to say, says, quote, "I'm not a techie person. Within a half hour, I was comfortable. If you know how to use a smartphone, then you can easily operate one of these trucks. The turning radius is better than my car." Pepsi says they run their Tesla semis 12 hours per day. 3 of the Tesla semis are dedicated to long-haul routes that can range from 250 to 450 miles. Quote, "We have been aggressively to push the limits and demonstrate we can achieve a high range with a fully loaded tractor." They worded that a little bit strange to read it out loud, but this news comes to us from, again, Sawyer Merritt. Finbold says 3 reasons why Tesla stock could hit $300 this August. Now, I'm not exactly a huge fan with this near-term price target of $300 in August due to the simple fact that we're probably going to get some weakness since Apple dropped about 5% on Friday. That's not going to have a positive effect on the markets, but let's hear out what they have to say. I do think 3 to 6 months from now, Tesla stock could be over $400 per share, and I think we need to discuss why later in this video. Finbold says Tesla barely reached $300 on July 19th, a strong resistance level that has already proven hard to break in the months of July through October 2022. Within the pullback, a strong support level formed at $250 per share, which coincides with the 50-day simple moving average. The stock price already bounced off of this level while forming a descending wedge pattern. This is a bullish pattern that is likely to break out on the top side. A break of this pattern should move the price to about $275 per share, making $300 an achievable price target in the next few weeks. They also say that 5 analysts have maintained a target price of $300 and higher. This is after Tesla's earnings and the stock has pulled back. You haven't seen the analysts jump on that bandwagon to downgrade the stock and lower the price targets. You've actually seen the opposite, and analysts have upgraded the stock and risen their price targets since Tesla's last earnings report, and that's probably because Tesla blew out their earnings. Tesla had fantastic earnings. The reason the stock fell was Elon on the earnings call, as most of you are already aware of. Third reason, Finbold says because it's Tesla. Despite all the headwinds in the current macro environment, Tesla is financially strong with over $23 billion in cash and revenue growth of 47% year over year. What's more, Tesla is not just a car company, it's a tech company. Now, 47% year over year growth is very impressive, and I think at some point that does start to be recognized by the markets, and I think that's a big reason why Tesla stock could rally over $400 per share within the next 3 to 6 months, once we get past this short-term volatility that we can expect to see in the markets. The reason Tesla stock could rally potentially to even new all-time highs 3 to 6 months from now is pretty simple. Analysts are wrong. No matter which way you want to put it, they are wrong. Their EPS estimates have fallen recently, even though Tesla massively beat expectations on their last earnings report. Estimates have fallen for next quarter, as well as for the fourth quarter, from 1 month ago, as well as 3 months ago. And analysts are only expecting 29% EPS growth in 2024, and they're only expecting 27% vehicle delivery growth. This would be the worst year Tesla has ever had in the history of Tesla as a business. I'm not willing to make that bet. I think as we get closer to the start of 2024, analysts will bring up their estimates. They will be forced to, as Tesla has better and better earnings throughout the rest of this year. And then ultimately what sends us to all-time highs could be the licensing of full self-driving, number one, and number two, the Cybertruck. Once deliveries actually start for this beast of a vehicle, you're going to see the order book grow at Tesla in ways that analysts just don't see. The bullish analysts don't even expect this. Besides a select few of them, Gary Black would be one, he expects 57% volume growth in 2024. That's sharply higher than 27% from Wall Street. Now, obviously, if a recession breaks out and all hell breaks loose in the economy, I'm going to be wrong. Wall Street's going to be wrong. Everyone's going to be wrong because vehicle makers do not do well during an actual recession. But I can't make a bearish case for a recession when unemployment is 3.5% and you're adding 200,000 jobs in the last month. There's nothing that I can point to that will lead us into a recession. But recession or not, the next couple of weeks are probably going to be volatile and skewed towards a downside move. I'm bullish in the midterm. I'm pretty bearish in the short term. That's because Apple just had terrible earnings. If you could categorize a stock as in a recession or not, well, Apple is in a recession. They have seen 3 quarters of year-over-year declining revenue. This is pretty bad news. Apple dropped almost 5% on Friday and is likely to continue to fall. Apple is 12% of the NASDAQ. It's pretty straightforward. It's pretty simple. If Apple continues to fall, it's going to bring down your big tech names. It's going to bring down the NASDAQ and the S&P with it. That's going to have an algorithmic sell-off effect to Tesla and other big tech names and everything for that matter, and stocks will fall. So until we get something to balance out Apple's negative earnings, the markets are going to fall. That's pretty simple and straightforward. Now, we do have some earnings this week, but the big story is going to be the economic data. Earnings this week, starting off on Monday in pre-market, there's a lot of companies that you don't really care about. Tyson could be an important one as far as food inflation is concerned to see what they say, but I doubt it will move the markets. Monday and after hours, Palantir, Lucid, Skyworks, Chegg, Paramount, Shockwave, Five9, and Beyond Meat report earnings. Tuesday, pre-market is UPS, Eli Lilly, Datadog, and that's about it. UPS will be very important, much the same way as Amazon was last week, because UPS is kind of a bellwether for the consumer. Are people still buying things? That's what you want to hear. Maybe it was only Amazon that seen good demand. Maybe it was Amazon Day, Prime Day, that had a positive effect to Amazon. We need to see what UPS has to say. Now, Tuesday and after hours, Rivian, AMC, Upstart, Twilio, Marathon, Celsius, and Luminar. Rivian, as well as Lucid, could be important for Tesla depending on if they mention price cuts and things of that nature. Wednesday and after hours, Walt Disney, Plug, The Trade Desk, Win, Canopy Growth, Sonos, Illumina, and smaller companies that are obviously not listed here. These are just your more important ones. And then Thursday and Friday, not too many notable names here. Alibaba, as well as US Foods, CyberArk, and Ralph Lauren, and Yeti, and Six Flags will report earnings Thursday pre-market. Thursday after hours and Friday pre-market, really no notable names to speak of. As far as the economic data, we're going to have a couple things that are pretty important, but we're going to have a lot of what's called bond auctions. Now, the way the Treasury sells bonds is it's done through an auction platform. Very similar to how you would buy a car, a house, or a storage unit at an auction. Bids get put in, whether they are high or low. That kind of sets the yields for bonds. Now, what started this increase to yields on the Treasury curve, the 10-year Treasury being the most notable over the past couple of weeks, was a 7-year bond auction that came in at 3.8%. Well, you were expecting 3.8%. It came in at 4.10%. It was about 30 basis points higher than when the auction started, just showing people did not want to buy the bonds. This sent your bond yields up to the highest level you've seen since October of 2022. At this time, the markets were crashing. This was the low for the markets. And well, specifically, I guess Apple was in January, but the low for the broader markets was back in October of 2022. Okay, a lot of it had to do with your 10-year Treasury. The best way to think about this, the higher this Treasury yield goes, the harder it is to get access to capital. The more likely you are to see bankruptcies. The harder it is to finance a Tesla or to get yourself a house. It directly affects your interest rates. So that's why it's negative. But what you seen on Friday was interesting. The 10-year Treasury dropped 15 basis points, and you can look at this by looking at TLT. When your Treasury yields fall, that means bonds go higher. Now, TLT rallied about 2%. Look what happened during COVID. When people panic, they buy bonds, right? And this actually started in January of 2020 as people started to get a little bit more fearful, and then it had that pop off top kind of rally, during March, the actual COVID crash. When people are scared, they buy bonds. Well, people got scared on Friday and they bought the bonds. That's not a good sign for a potential market crash and some capitulation that did happen in stocks like Apple. A lot of people are going to say it's profit taking, which I would agree, but you did see some people just capitulate and say, hey, I'm done with this stock. We got the gains. I'm going to leave. I don't want to hold this stock anymore. You've seen a fear move. Whenever you see the markets go down and the bonds go higher, that's not a good sign. You can remember that throughout your entire lifetime of trading. Whenever that happens, it's not good. Now, as far as the economic data, like I said, you're going to have a lot of bond auctions this week. If you guys want to look at these all for yourselves, trading economics calendar. Put that into Google, you will come to this website and be able to look at the same exact data I am looking at. So on Monday, you don't have any big economic data coming out. On Tuesday, same thing, nothing to speak of. Wednesday, nothing as well. And then on Thursday, you're going to get inflation. Inflation is going to be very important. Now, your core inflation rate month over month for July is expected to come in at 0.2%, the same from last month, as well as your headline month-over-month inflation reading, again, at 0.2% is the expectations. Last month's reading was also 0.2%. Now, core inflation rate year-over-year for July, you're expecting this at 4.8%, the same as last month. So nothing is expected to change on any of these readings year-over-year or month-over-month as far as the core month-over-month and year-over-year and headline month-over-month. Now, your headline year-over-year is going to be the big story here. You're expecting this to go to 3.3%. Last month's reading, 3% inflation hit the headlines. I like to think your month-over-month readings are more important because they're more relevant to what is happening now, not just comparing now to a year prior. But unfortunately, your headline year-over-year tends to give the markets the biggest reaction. You're expecting a rise in year-over-year. This is largely due to the base effects of inflation being really high last July and inflation being lower today. And then as inflation goes lower, right? Or I mean June, it was really high, and then July it started to come down, right? As you start to get that, you start to get a weaker year-over-year comparison, and now it's starting to strengthen again. So let me tell you right now, if this reading comes in higher than 3.5%, you're in for a problem. You're probably going to see a 2 to 3% down move in the markets. If you still come in at 3.3%, you're probably going to get a 1% down move. Markets want to see this number 3% or 3.1%. That's where the markets want to see this. If it's any higher than that, you're going to have a problem. Now, Friday, you're going to get PPI month over month. Think of this as producer price inflation. It technically stands for producer price index, but it's the producer side of inflation. You're expecting this to go up from last month's reading at 0.1% to 0.2% in July. And Michigan consumer sentiment is expected to come in at 71. Last month's reading was 71.6. So a little bit of a drop, but still a very nice chart when you look at the Michigan consumer confidence. That's technically what the survey is called. Over the last 3 months or so, it's increased dramatically. The 5-year inflation expectations as well as the 1-year inflation expectations are going to be very, very important. Now, for those of you guys that made it to the end of this video, let's talk about a potential hedge you could put on in your portfolio if you are someone that wants to make money from any potential downside in the markets. Now, if you guys like this hedge, you want to come trade with me live in real time every time I put on trades like these, link down below in the description of this video. So this specific trade that I have on right now, you guys can see the plus over here. I have 92 of these. They're called put debit spreads. Now, ever since COVID and options became popular, buying options outright has been very expensive, and it has made your risk to reward ratio a lot lower, right? It doesn't make sense to buy options most of the time. Now, I went out and I got these put debit spreads, and I bought the 160s and I sold the 155s. I did this 92 times, meaning that your max gain is $500 for every one of these. And now how you'd actually do this if you're on Robinhood, it's the same way if you're on Webull and other brokerages as well. But you would buy the 160 in the same kind of trade, click on the sell the 155, that's going to be $6 a piece. Do that by 92, $552 you're going to get into this trade. And your max gain is about $45,500 if Apple closed down 14.86% from here over the next 19 days. Now, even if you don't get the max profit, if you do see a big down move this week or next week, say Apple drops 5 to 7%, well, this trade's probably going to go up 2 to 300%. And then you could take your profits and go. Obviously, this is not financial advice. I'm not a financial advisor. You could lose all of your money. You're best off just buying Tesla stock today. That's going to give you a much higher, almost guaranteed gain. But this is a way to hedge your portfolio if you're scared or you just want to make some money on the downside move in the markets. This is a way that you could do it. Obviously, don't copy this trade. You can do different versions of this trade, but this is what I currently have on my portfolio. Logic is if you make 5, 10, 15, 20,000 or 46,000, you take those profits, put that back into Tesla stock. At least that is what I plan to do. Again, if you want to come trade with us, link down below in the description of this video. Nonetheless, that's going to do it. Hit the like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. Thank you guys for watching, and I will see you in the next one.